with Australian households navigating the impacts of inflation. David Clark from Cameron Harrison joins us to discuss some of the other influencing factors that are at play. Good morning. Thank you so much, David, for joining us.
Thank you for having me. Thanks. Good to be here.
Okay, this is a really interesting subject you want to delve into, and of course it is these record immigration levels. Just as a casual observer, I am starting to note a little bit of pushback starting to emerge in Australia. Can you outline some of the pros and the cons of this policy that is being pursued?
Sure. So on the pro side, adding additional people into the Australian economy adds to the resilience in terms of consumption. More people, put simply, means more consumption, more income tax that gets paid, and more government receipts. So that adds resilience. On the downside, though, from a household and from an individual person's point of view, it usually leads to weaker wage growth, normally lower productivity growth as well. And in the long term, we know that lower productivity growth means lower real wages.
Yeah, absolutely. And that again, though, has some interesting conundrums. And I'll get to the housing market in a second. But if we get too much wage growth, then clearly that's working against the inflationary target. So probably the more important thing, why does it lead to potentially lower productivity?
Yeah, if you make let's assume that wages, remain in a nice band in that 3.5 to 3.6 point of view. If you don't make wage growth stronger, you take away the incentive for business to look at investing in ways to save labour and ways to be more productive. So by actually adding more people, you're making it easy for business to continue doing what they're doing and not incentivising them to get more efficient and better at what they're doing.
Fair enough. Now, of course, we have had the steepest rate hikes since the early 80s, and now all of these rate hikes haven't actually been passed on to the to the mortgage holder at this stage. Can you run us through the dynamics of what we've seen during the pandemic and now that we have moved into this rate hiking cycle?
Sure. So, obviously the low rates that we had during the pandemic, where the RBA cut rates down to 0.1, led to a lot of mortgage holders to take the opportunity to fix their mortgages over, a 3 to 5 year period. They also took the opportunity when they were getting nice government payments during COVID to pay down some of their debt. What that's meant is that as interest rates have gone up, as you said, very sharply, over 4% so far, but not all of that has passed its way through. Probably only about 2/3 of that increase in cash rate has gone through to the average mortgage rate. So we still have a third to go. And that's important because as this graph shows here, households are making the same payments each month, but more of that is required payments to cover the increasing debt costs there. So as the remaining 1/3 of this tightening goes through, households are going to find it more difficult, and financial conditions are going to continue to tighten even if the RBA keeps interest rates on hold.
Absolutely. And just also, let's go back to that, the whole impact of this higher immigration levels and what it's actually having on the household per se, because we are seeing it in higher rentals, higher housing prices, which really has flummoxed a lot of people this cycle. It's not what everybody was expecting. And we've had over 450,000. So we've got a really good chart that you have there of the workforce, the US versus Australia. Can you run us through what this chart is actually telling us?
Yeah, sure. So running a high immigration policy is not overly new in Australia. Certainly we've taken it to new levels post-pandemic, but we've been relying on immigration for our economic growth for over 10 years now. So in the post-COVID cycle, so FY23, our net immigration is nearly 6 times higher than the US, which also had a above average year of immigration. And if you extend that over a longer period of time, we've actually seen our workforce grow by over 22% in the last decade compared to just 12 in the US. So just constantly adding in new workers into the workforce, that's what flattens wage growth. And that will make, in one hand, life easier for the RBA because wages growth ties into services inflation. But on the other hand, it's going to be very difficult for households that find rents going up, harder to get rentals as well, and also wage growth falling behind inflation.
David, if we cut across these two really big issues that you've raised today and translate that into the outlook for the Australian economy and therefore, I suppose broadly the equity market, it's not exactly an upbeat picture, is it?
No, I think something has, I titled this paper, something's got to give. We've been surviving on savings that have been built up through the pandemic, further tightening's coming through. Yes, immigration is adding a bit of resilience, but that's hardly the type of environment where you're going to shoot the lights out. If you couple in a weakening China where, its demand for our commodities is probably going to be weaker than what it was in the last decade, it's not exactly shooting the lights out.
And implications if China isn't looking absolutely fantastic, and we obviously have a broad exposure to housing, in Australia and resources, that sort of would then reflect back on the index as not being great.
Yeah, no, not at all. So it ties in two ways. So one is just straight through the equity markets, which, as you noted, commodity producers are a big part of our market at over sort of 25% of the market cap. But it also flows in through government receipts as well. So we got a big national income boost from selling commodities over to China, and that's flowing through into government redistribution, and that gets more difficult going forward as well. So less support for households.